Hey folks, Lane Cowell here. We are going to be opening up the mailbag. This is the Ask Me Anything show where I answer your guys' questions. And if you guys have any question you guys want to get answered live, please go and comment below. Or if you guys have any comments, let's get a dialogue going. So first question here. Is the syndication of real estate listing considered to be a solved problem, or is there room for improvement? If there's room for improvement, what problems can be addressed? So I think the cool thing about real estate syndication is it allows folks to get involved in this middle run of investments, right? Like in normal investing, you have either the big sharks or institutions investing lazy retirement money for paltry returns. Um, these are the big Wall Street companies. They typically go after portfolios of huge properties in the 1,000, 2,000 plus range, or maybe half a dozen properties or greater. Um, on the very low end, you've got mom and pop investors buying single family homes, duplexes, triplexes, quads, maybe 20, 40, 50 units, or even 100 units. But what real estate syndication does is, you can pull, I mean, you can pull anything together, but to me, it doesn't really make sense unless you syndicate more than $1 million of capital. And if you're going after 60, 70% loan to value type of loans, that means a purchase price of $3 to $5 million. So now you're talking about like a 30 to 50 units at the very smallest. But what I've noticed is like when you put together deals, you really want to get higher than 100 something unit counts. At the very least, the bigger the better, because not only after 60 units, now you can justify an in-house property manager fee at the property at all times, which is a heck of a lot better. Commercial property managers are way better than residential property managers in terms of sophistication, and you're also aligned with them. Whereas residential property managers, when you have a vacancy, it's good. It puts more money into their pocket and takes money out of your pocket, which is that misalignment. But what you really want on economies of scale is these bigger properties where you can justify handyman staff, HVAC staff, plumbers, repair guys on staff, take care of a lot of this stuff on salary. And somebody mentioned to me the other day, do we have any handymans that they can have as referrals? Like, well, we don't. Everybody's on staff. They're all our guys. I'm out because it's tough, right? Working with handyman or all these small vendors. You're in the retail market in the small and mom and pop investor realm. So that's what a syndication does. It allows people to go after 100 to 600 unit apartment complex, or you can syndicate anything. You can syndicate mobile home parks, self-storage facilities, really get to that a great economies of scale, but really not on that large institutional scale where I think at that point you just become bloated, right? Insurance companies will buy big portfolios of properties, REITs. Just in terms of like scalability, that's what they do because they need to stroke a pen, make a signature, and buy a bunch of assets because that's how they're compensated. They're compensated in assets under management. So they're going after economies of scale, not necessarily managing the asset to what it should be. I think that there are a lot of opportunities for crowdfunding websites out there. I'm not a big fan of those. I don't invest in those types of things. I just think that we're maybe about a decade or two away from that stuff to be really viable solutions. Right now, I mean, the crowdfunding websites will charge the operators an arm and a leg to put the deal up there. And I've seen what they charge, and it just doesn't make any sense, right? If you're a good operator, why would you pay like an arm and a leg to these folks to play the middleman when you can just give it to yourself or more importantly your passive investors, give up that profits to them instead of paying a middleman? Still a lot better than Wall Street or mainstream retail investing like REITs where there's all these middlemen and guys involved. The crowdfunding platforms is kind of just one middleman, but still middleman's a middleman. I prefer to invest directly with the operator where I kind of know the people I'm working with. I've kind of used this analogy a lot, and I hope I don't offend anybody, but it's kind of like the online dating scene of the 1990s. It's kind of it's like the 4chan or the forums back then. Nowadays, everybody does internet dating. I think maybe probably safely say after the 2010s, it's kind of the norm. Most people move that way. And yeah, I think crowdfunding websites will get to that point at some juncture, maybe again 20, 30 years from now. But at this point, we're still in the dark ages, I think, of that stuff. Before we head on, if you guys have any live questions, put it into the comment box and in the comments there. If you were not able to get it and you're looking at the replay of this episode, go to simplepassivecashflow.com/question. We'll add it to the list there for the next one. Next question. Is real estate investing a dying field? Is it worth breaking into real estate investing? Well, I think it's always a great time to be real estate investing. And real estate investing to me is more of an end game strategy, or once you have a decent amount of net worth. If you don't, right, you have to make money. And one way some people will make money, and which we don't do here, is more active type of real estate investing, like flipping houses, wholesaling. A lot of that is just putting in sweat equity. If you're a high paid professional making over $50,000-$60,000 a year, you've got a family or you've got a decent amount of net worth, maybe $250,000 net worth. I think a lot of that house flipping stuff is kind of a waste of time. And this chart right here, Adam came up with a bunch of data saying the volumes for house flipping is going up, but the gross profits are going way down in the last several. Actually, this has been quite the trend over the past year. And what is that saying? Well, a bunch of amateurs, more amateurs, buying all these, getting on the HGTV bandwagon or getting into house flipping. Again, this is why we get away from retail, residential, house flipping, single family homes. We try and swim upstream to bigger assets where the amateurs can't really compete with us on the bigger scale. Because it's a race to the bottom at this point for house flippers as profits are coming less and less. In fact, what I see is a lot of good house flippers kind of realizing that it's kind of a race to the bottom, and they're getting out of the actual house flipping and just becoming just private money lenders. And there's this thing called mezz debt. You invest in people, and with the sole intention of stealing the property from them when they don't meet their loan covenants, and you can take over the property. It's a little predatory, but it's actually kind of smart if you think about it, right? Because there's a whole bunch of amateurs getting into this type of stuff, and they don't know what they're doing. They're a bunch of like accountants and non-industry professionals getting into like operating construction projects and contracts just out of their league. But that's something I see out in the lower rungs of the house flipping ranks. And I try not to get involved in that stuff too much. So going back to the question, is investing a dying field? I think if you're looking to start at the bottom in the house flipping, wholesaling world, it's a doggy dog world. And I would say, the thing is anybody can kind of do that, right? Flip some houses. And when anybody can do it, you don't want to be in something. You want to be in something where it's hard, where the barrier to entry is extremely difficult. Right? Just take like apartments, for example. Unless you have Fannie Mae, Freddie Mac experience buying 100, 200 unit apartment complex, you can't get the debt and financing for that. And if you can't get the debt and financing for it, even if you have a good deal, you can't get it done. It's an incredibly unfair game, and that's what I like about multifamily syndication. Is it worth breaking into real estate? Well, if you're a high net worth investor, real estate is always a great investment in terms of end game, right? Most of our clients are high paid doctors, lawyers, engineers, and we have a lot of folks who've made a lot of money with crypto and have come in from that side, or a lot of people who have exited successful businesses, right? Be real successful entrepreneurs instead of the entrepreneur type that you see on LinkedIn a lot of the time. Because they've realized that they've concentrated their focus and sweat equity into one thing, but that may not be the long-term sustainable success to get them and to stay to that level. I was watching a video on the people who made the Forever 21. It's like a Korean couple. They got up to, I think, $4 or $5 billion net worth, but they lost like half of it because the industry changed, the retail market changed. And I was also in a family office presentation where they kind of echoed the same thing. People get to high net worth for one reason, and they also lose it for another. What got you to one place probably isn't going to have you keep it where you're at. Now, that's talking to $100 million net worth families and above. If you guys aren't even to $5 to $10 million net worth, forget I said anything like that. You guys still need to get up to that shelf. It's very common. People who have less than $1 million net worth, they watch a lot of YouTube videos about inflation and they get all freaked out on this baby stuff. They, the messages that I'm saying or other people are saying may not pertain to you. What I'm saying, if your net worth is between $1 to $5 million net worth, you still have to concentrate into something to build legacy money at that point. Which US state has the cheapest real estate? So I think this question was sent in because maybe they don't have enough money. And look, if you don't have money, you can't real estate invest. Real estate investing is capital intensive. Sure, there's ways. I mean, there's no way you can get into something for no money. And there's always a catch, right? All this wraparounds, notes, and stuff like that. It doesn't happen anymore. And if it did, it would take you a lot of time and energy, sweat equity to find it. If you're trying to rehab a property, there's a lot of risk involved with that. Most of the folks in our community have a decent amount of net worth, and we're more looking to leverage what we're already doing in our day jobs or businesses as opposed to going out and fighting outside of our lane. Uh, so, but if you kind of pulled my arm here, like US state that has the best, cheapest real estate, I think what the thing there, I mean, a lot of places in the South and the Midwest, not necessarily the best places to invest. Like one state that we're involved in is the state of Mississippi. I mean, things are just dismally like cheap out there, but not a lot of big economic drivers out there that makes sense. One of the big KPIs that we look for is population growth because of economic drivers like jobs coming in, but not because something is the cheapest is the best, right? And also same for the same thing, just because something is expensive doesn't mean it's the best, right? People always say, oh yeah, yeah, we hear you, right? Lane's always talking about rent to value ratios and like not buying places in Seattle, California, Hawaii because it's expensive. Yes, it's expensive, but it's more so like what is the price, what is the rent that you get for the price that you pay, or the rent to value ratio that we're looking at. And then what are the drivers, which also impact the occupancy that you're going to get. I mean, it was like a market that I think like Jackson, Mississippi. I mean, I don't want to pick on Jackson, Mississippi. Very cheap out there, but vacancy is pretty high out there typically. Um, so everything looks good on paper, but you might run 5, 10, 15% economic vacancy in that type of state. And of course, it's all block to block. It's all sub-market based and property specific. But you guys asked the question. I'm just trying to answer the questions. Um, Going back to the other question, somebody asked, what about wholesaling? Well, wholesaling is not real estate investing, dude. It is a real estate activity that happens to be in the realm of real estate. Wholesaling is what you do when you don't have that much money. You have to make something out of nothing. You spend a whole bunch of paid ads, marketing mailers. You do that driving for dollars thing. That is just the cheapskate form of wholesaling, where you're trading your sweat equity for finding good deals. I don't really believe in wholesaling. I think it's a little unethical because essentially what you're doing, you're trying to go around, you're trying to trick a bunch of suckers into selling their house to you for 50 cents on the dollar when they could just fix it up themselves and go to a broker and get a much better price. But hey, however you guys want to make money, I guess if you're not killing anybody and you're not breaking any laws, then it's up to you. But I just not a big fan of wholesaling for those reasons, and it's not a passive way of making money. Look, if you make less than $50,000, $60,000 a year, you may have to wholesale, and especially if you don't have any money. But if you make a professional wage and you have more than a couple $100,000 of net worth already, put that money into passive real estate investing. One of the biggest mistakes I see, even from successful wholesalers, And I'll get into that in a little bit right after this point. But like a lot of these guys will just continually just feeding, they'll just keep buying yellow letters and advertising, and they always are active, 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 active. I mean, I like these guys because they pay all my taxes for me. I like the whole house because they pay all the taxes on ordinary income. They haven't figured out how to build wealth, which is by passive income. More importantly, before because it becomes passive income, which you can use your passive losses to offset that income, and not and taking all that, keeping most of those gains. And the other reason why I don't like wholesaling is because I used to be in a very high level mastermind called the Collective Genius. You guys can Google it out there and see some of the rock stars in there. And these guys are absolutely insane. And they are so, I mean, I think they share all their flow charts and their systems and their hiring practices. And it's just insane what these guys do. And if I was a beginning wholesaler with my like $5,000 marketing budget, I mean, I'd be peeing in my pants because these guys are going to eat your lunch all day long. Like these guys are spending like 10 grand per week or some even every few days on paid marketing. They have like sweatshops of overseas, in seas, or US based salespeople just like going after it. Little mom and pop investor who just got a Carlton Sheets infomercial or like a $500 e-course that's a bunch of stuff that was popular back in the 1990s that worked back then. It's just an unfair game. Um, and that's why I would never want to get involved with that. But like for most people with some money, yeah, wholesaling is just not the thing. Is real estate syndication followed by managing the property and renting it out to Airbnb a good idea? Potentially a good idea. I mean, you can syndicate anything, right? Let's just get that straight because you can syndicate a pizza parlor, a brewery, a very sexy skyscraper development. You can syndicate a stabilized Class C apartment. You can syndicate anything. Um, so you can also syndicate. What I do see out there is like you buy like a crappy little Comfort Inn, like one of those Class C hotels, and then you make it nicer and you turn it into a Class B apartment. Or some people will Airbnb a section of the units, and or maybe just Airbnb the whole thing. Um, I just it's very that's more of a niche strategy. I'm not a big fan of short-term rentals too much. I'm not a big fan of big of niches in general, right? Niches, what I mean, like examples, um, assisted living from an operator standpoint. I don't really like investing in military towns because if the military goes away, you're completely screwed. I don't like college towns because if the college, especially like a Division 1 college, just builds a dorm, they're screwed. I think the only place that might work is like those smaller community colleges, D2, D3 schools, where the school won't really build any student housing on campus or around campus. So I think those that might be a little bit better way of going about it, but I just don't like these types of niches. I like workforce housing, and it's the glut of America. Why deviate from the majority, which is the need? And there's such a huge demand for lower middle class housing. Airbnb's short-term rentals, it's a discretionary item. Right? When there's bad times in the economy, this stuff goes bad because people stop spending money on this type of stuff. And in good times, it does really, really well. The returns are great. But in bad times, it's a bloodbath. This type of stuff. Is it legal to rent a house and turn it into Airbnb in Oahu? I mean, I don't know, man. I mean, maybe it is today. Maybe it won't be in 3 months, right? You're subject to all like the rules that are all asked backwards from the government, right? I mean, here in Hawaii, the hotels have such a high power and just makes no sense. And that's why I want to take myself out of all that. I want to take that variable out. I only want things that I can kind of control. Um, I think people get wrapped around like they see like the big, oh, I can make $200 or $300 a night, right? Well, when you actually get into the business, you start to learn about utilization. You're not going to be renting that property out every single night, and unless you want to be out there changing the sheets all the time, and you're going to have to hire people, and you're going to have to run it like a legitimate business. So I would say, again, and this is where it's like, well, are you an investor or are you a worker, right? Trading time for money. We're all trying to get to, there's two people in life. There's people that trade time for money, and there's people who let money work for them. And maybe their money isn't growing as fast as these guys, but it's the best time effective, best use of their time. They're saying, well, I figure because let's see a lot of people advertising on IG using Craigslist and their search tools, and we sell to the flippers. Well, see, this is another reason why. Like, if I see something, it's the taxi cab driver rule, right? Or if you hear about regular people doing it, I'm out. I don't want nothing to do with it. Um, but that's just me. I think in The Big Short, the stripper and the taxi car driver buying houses, that should have been a clear sign not to knock that stuff off and stop buying houses just for appreciation. I mean, it's money talks, and this stuff is all like big noise to me, especially on social media. But the people who are wealthy invest in the most boringest things. And to me, what I personally like is workforce housing, short, long-term rentals, no tricks, no games. Some other people will invest in larger businesses like waste management or like widget makers. It's the boring stuff that kind of has stable wealth over time. Now, why don't you see it? Well, you guys aren't $100 million net worth. You may or may not have friends and family like that. You just hear about the new money who just got lucky and got up to that point. But I think a lot of people who have that much money, they try and be a little private about that, and maybe they just think it's kind of boring too, so they don't talk about it. Good questions. Thanks for the comments, folks. If you guys are interested more in syndications, we're going to do a free cram school for folks October 16th, which is a Saturday, from 9 a.m. to 11 a.m. Join this link here, simplepassivecashflow.com/club, to get on the list for that. And if you guys want to study ahead, go to simplepassivecashflow.com/syndication and start studying up so you can actually ask good questions instead of asking, well, it's a syndication. All right, diving into some more questions. What is an example of an investment opportunity that would require the formation of a real estate syndication? So maybe let's start off with like this. Like, again, we talked about earlier, you can syndicate any type of investment, whether a pizza parlor, I don't know why I keep using that as an example, but a brewery, a development, a real estate development, a stabilized multifamily Class C property. There's an infinite amount of things you can syndicate. You can syndicate a tech startup if you wanted to, where essentially there's a general partnership party, which are kind of the brains of the operation. They take on a lot of the risk as managing members, and oftentimes they're signing on the debt on behalf of the rest of the passive investors who have a very limited downside in terms of liability and not having the debt under their personal name. So it's a great opportunities for those two classes to work with each other in whatever endeavor that may be. So when does this make sense? Well, when you pull together passive investment money together, you've triggered securities law, SEC type of stuff. And once you've done that, you've got to hire a lawyer, do all these blue sky filings. I don't exactly know what all is involved with, that. I just kind of pay the lawyer and they do all this stuff. But we pay them a lot of money. I mean, it could cost anywhere from like, $8,000 on the cheap side, all the way up to $25,000 to get it all said and done. And it is, it is completely mandatory, right? As soon as you take one investor dollar from somebody who is a passive investor, you've triggered securities law. People like to do all these like tricks and games and shady things. Look, I don't want to screw around with the SEC and have them coming after the feds in that case. So, let's just say you're going to be spending $10,000 to $20,000 on legal fees. Well, you've got to do a big enough project for this to make sense. So what I tell most people is like, well, unless you're going to need more than $1 to $2 million of liquidity for the down payment and repairs, it's just not worth it. And you're probably better off just getting a bunch of friends and family to all put in larger chunks where you're all JV managing members of the investment. So there's kind of like a no man's land between, I mean, $3 to $5 million or less. Once you get above that threshold, it makes sense to kind of actually do this and formalize it in a syndication. Why do real estate syndicates sell and manage cash flowing properties? Wouldn't it be better for them to keep all the profits? How do people make millions through real estate syndication? So this question comes up a lot, right? Like I think when I was doing turnkey rentals way back when, everybody, people would ask similar question. Well, why don't the turnkey providers just buy all these properties for themselves if it's such a great investment? Well, the turnkey providers are in a business of turning and burning and selling assets to folks with a little bit of markup so that they can make a profit for themselves to put food on their table and build a their network that way. And no different. Syndications, I mean, they're great deals. Why isn't the syndicator just doing it themselves? Well, smart people, high net worth people know it's always better to not share it from some kind of like, oh, it's the nice thing to do. No, you bring in as much other people money as possible so you can not only do that one deal but do multiple and keep doing this again and again and again. The cool thing about syndications is you've kind of created infinite amount of money and you can go do infinite amount of deals. You're just kind of limited to your team bandwidth or your own bandwidth. Whereas let's just take it from the more extreme example, right? Like one guy, he doesn't have any money. He wants to buy a house to live in or a rental property, right? If he didn't use the bank's money, then he would take I don't know, maybe like 20, 30 years to save up that whole price of the property. And we all know that that's completely wrong way of doing things. And you get a bank loan, you save up the down payment. That's the hardest part. But what syndication does, it kind of aggressively increases that time horizon where the down payment and the cash reserves, working capital, all the money for the repairs is raised by an external source, which is passive investors. And once you've built up a track record and you've shown good results, it just keeps growing and growing and growing. And you can kind of keep doing deal after deal after deal after deal. And it's a beautiful thing because the deal makers that pull this stuff together, their net worth keeps growing. They can continue signing on more and more debt themselves and taking it off the passive investors. And their expertise is more pulling other people together. We're getting to a point where a lot of myself are hiring a lot of chief operating officers, 100,000 people that made more than I did at my day job. We're bringing in these guys to kind of take this company to the next level so that I can free myself up to do what I do, teach you guys this stuff, but more importantly, play business development and find other synergies with other partners and more institutional firms out there. Because apparently that's kind of the magic, right, behind simple passive cash flow and investing in deal making. It's not really managing the property manager, right? That's quite honestly $100,000 a year type of job. That's a job. It's just like a property manager. You don't want to be a property manager. Heavens no. I think a lot of people listening are sophisticated enough that you don't want to be the landlord. You want to be the investor. So for the same reasons why you don't manage your own properties is the same reasons that we want to start outsourcing asset management or property management on our side. It's just a smart business thing to do. And people make millions doing this because you can just keep doing this again and again and again and again and again. And what's crazy is like the bigger you get, the better deals you get. And then when you do these bigger deals, you also have better vendors, right? I mentioned the difference between regular residential property managers and commercial property managers. But what I'm starting to notice now is we start to hire professional engineers for our design, plan, specs, construction management. I mean, I was in the construction management field and I was the project engineer. I was never the design engineer. I'm horrible at that type of stuff. That's like super smart people, right? But we're hiring these super smart people and these guys that are getting paid $60,000 to build plans and specs for us. And these things are ironclad. I mean, we're putting the right brain people in the right places to give to what we want as the business owners and the investors. And this is why the rich get richer and the poor get poor, because the bigger you get, the easier it gets. How is it possible for companies to sell securities to non-accredited investors? Been seeing a lot of these advertising in the real estate sector, and why would you want investors that can't afford their money? So if okay, so sitting from the syndicator's perspective, there are primarily a couple ways you can go about raising capital through a 506B offering and 506C offering. And look, I'm not getting any legal advice here. I'm just a guy that kind of lives within the confines and hires the right professionals that tell me what keep me in mind. But here's my quick understanding of this whole thing. There are 506B like boy offerings, 506C like cat offerings. So the C like cat is this newer form where it allows the syndicator to mass market the deal. And this is typically what you'll see on crowdfunding websites, or what you'll see kind of just pop up on your Facebook feed as an open deal. And it's I guess it's kind of cool because it kind of gets the word out there. It's a little bit of a Hail Mary. I mean, like, you don't know who you're investing alongside with, but it allows the sponsor to kind of get their name out there, especially if they're getting started. But once they do that, the government's like, well, we want to protect little Johnny who only has $20,000 to his name and not let little Johnny invest. So that's why they're like, well, you can only accept accredited investors, and that's why the requirement for third-party verification is in there. 506B offerings are not mass marketed; they only go out to a private network. And most deals, I would say anywhere from 90 to 97% of deals are still 506B offerings, only going out to a private network. They accept a limited number of non-accredited investors, but you have to be quote unquote sophisticated. Now, we're not going to get into what that word means, as nobody really knows. There's not really a good definition out there. But if I were, what I'm guessing this question is also asking, there is a Reg A plus offering. So if some of you guys have seen our podcast sponsor, AHP, who's coming out with a new fund here shortly. Now, the Reg A offering, we mentioned how syndication costs anywhere from $10,000 to $20,000 to put together. The Reg A plus offering is maybe $50,000, $100,000 is what I heard. It's a lot more expensive, and it takes a heck of a lot more time, maybe 6 months plus to originate. But once they put that together, now they can go out and accept non-accredited investors and mass market. So it's kind of a best of both worlds, even though it kind of takes a while for it to get the tank set up in a way. So perhaps maybe that's what you're seeing. But unless it's a Reg A plus offering or some other more obscure offering that's registered with the SEC, it is illegal for them to mass market and bring in non-accredited investors. But you're probably right. Like most investors that invest in these types of stuff, especially when the minimums are not to a laughable point under $30,000 or less, the investors are accredited. And like non-accredited investors, typically people don't like to work with them because they are not educated in terms of investing. They freak out whenever one little thing happens. To become a total investor relations nightmare and a time suck for the syndicators and operators who really should be spending their time on managing the dang asset than to placating investors' little concerns. After all, they are passive investors. And once a passive non-accredited investor has invested in a deal or two, likely they blew their whole load. They ran out of money at that point, and they're not really useful anymore. Where a lot of accredited investors, they make $50,000, $100,000. They'll save that every quarter, so continually going into deals. Again, rich get richer, poor kind of stay where they're at, or the shrinking middle class stay where they're at. So you're right. Yeah, it makes no sense to be take in non-accredited investors. Unfortunately, it wasn't too long ago that I was a non-accredited investor, and damn it, well, if you don't invest in non-garbage retail investments that's offered only through your 401ks, mutual funds, stuff like that, well, how the heck do you get the tax benefits and get better returns and cash flow to get accredited status? So it's a frustrating thing, and I don't know. Maybe one day we'll do a Reggae Plus to get around to that. If you guys like this type of stuff, check out my podcast at passivecashflow.com. Passive real estate investing. It's also on iTunes, Spotify, iHeartRadio, all such. Next question. Where would you invest $150,000 if you're not an accredited investor and you wanted more risks than public equities, but less touch time than real estate? Ooh, great question. I would probably follow up asking, well, where is your net worth, right? Because that's going to tell me a little bit where your risk profile is coming from. If you're like $250,000 or less, I would say go out and buy a rental property. And if anybody was willing to really take your money as a non-accredited investor less than $250,000, I would say run, because that syndicator's probably desperate to freaking bringing you in. If you were $500,000 or greater, what I would do is I like stabilized cash flowing apartments with a little bit of value add. Should there be a recession, you'll be okay. You just hold on to the asset and cash flow. You're not going to make as big returns as the development, but I think with the developments, there's a bigger like spread of like there's a lot of sucker deals, and there's only some good deals out there in the development world. And likely, if you're just some non-accredited investor, you don't have access to the good deals. You're just taking a look at the garbage sucker deals that are marketed to retail plus investors that only invest off the pretty pictures. So, assuming you don't have a good network, your parents don't do this type of stuff, your friends and family don't invest, you're not accredited, I would say just go after like this kind of the singles and doubles, to use the baseball analogy, and just go after a cash flowing asset first. And if there's value add, great. And then I think a lot of people, I mean, that's kind of no man's land, right? $250,000 to $1 million net worth. You're not broke, but you don't have the experience. You have to figure out what is a good deal, and you don't have the network, right, of other passive investors around you at that point. Is roofstock the easiest way to buy turnkey properties? So roofstock, actually, I like them. They pull together and work with a lot of different turnkey providers. So instead of you going through all this like stuff of like who to work with, roofstock kind of works out deals with them, and they're kind of cheap in terms of like their commissions that they serve up to the buyers and sellers. I think it's only like 1.5 or something like that. Um, Still do your own due diligence, right? I mean, they're not guaranteed results or anything like that. Um, but whenever you're buying a turnkey rental, you're buying it retail plus, right? So you're not really getting a great deal. But if you're a high paid professional, you probably don't care, and you just want to get some experience under your belt. You guys want to kind of buy from my referral link or work with the folks that I've worked with in the past. I've worked with Roofstock before. They're good to work with. Go to http://bit.ly, and the magic code is /33HKDAK. And yeah, either that or buy me a Scotch whiskey or something like that for the tips that I've been giving you guys, or drop a like below or whatever platform you guys are watching in. But yeah, like I think it's a great place to sell your properties, because a lot of new turnkey buyers will go there. I actually sold like 6 of my properties on Roofstock. So what's cool about that is you can sell it tenant occupied. So if you're kind of like, I'm done with these turnkeys, right? I did my thing with it. I want the syndication deals. Now you can, without like kicking your tenant out and now running not having your income stream coming in every month, you can put it on a Roofstock and have the tenant still stay in there. And actually, that's what the buyers want. They want a stabilized tenant that's in there already. So it's kind of the best of both worlds for the buyer and seller yourself. I think we had a follow-up question on what states do you like best for turnkey rentals? Let me get my map out here. So yeah, the Sunbelt states are great, right? That's where the population increase is going on. So if you see my map, you guys don't see my map here, but like the Sunbelt states, a little smile across. Like generally, people are moving from the northern states down to the southern states. Of course, the biggest thing is you want to be in a red state because you want the landlord laws on your side. Uh, as far as turnkey rentals are always going to be overpriced. So like places that you would normally think of like Arizona, Texas ain't gonna work. I don't think you're gonna be hitting your 1% rent to value ratios. And that's what's hard about turnkey rentals. I think when people start to Google this stuff, they just find the perennial big names. And those guys a lot of times are like pumping the price up by like 10, 20 grand. It's absurd. I mean, you pay for like, I guess reliability, I guess, but I don't know if that makes sense, to be honest. Um, and because think about it like this, for a house flipper, a turnkey rental is kind of the way for them to get into the game. It's a smaller scope. A lot of times it might be $20,000 to $50,000 of construction scope. Whereas, if once they get good at what they're doing, they get the hell out of doing turnkey rentals and working with cheapskate investors like you guys and me. And what they do is they go to more retail investors where they do bigger properties like 200, $500,000 plus, and they're trying to find that emotional buyer who will pay a lot more. And this is after they've gotten more established. So it's a constantly revolving door, and this is why we've shut down the incubator group because I'm kind of like I'm not really feeling the turnkey stuff anymore these days, especially because most of the people in our group are accredited investors or higher net worth, and quite frankly, having a few $100s of cash flow from one property is kind of a sleeper and bore for most of the folks in our group. But hey, I mean, I'm here to kind of help out everybody get started. If you're not in like credit card debt and you're not, you don't have those basic financial issues. Which, by the way, if you guys are, just starting at scratch at square one, you guys can text the word basic to 314-665-1767. And I created a basic financial course because people would ask me all these like really basic questions like, what's a Roth IRA? How do I budget? Like, well, I don't. I mean, I know, so I created an e-course there for free for folks to get out of credit card debt or just get their stuff together. It's great for like people straight out of college. If you guys want to give it to your kids, you guys can go and download that or get access to that at the member site. Again, basic. Text the word basic to 314-665-1767. And then I guess while we're giving out free stuff, you guys can text the word remote to 314-665-1767. And you can get the remote rental light e-course, and which we're talking about all these turnkey rentals. These are remote turnkey rentals that we're kind of talking about. But back to the question, what states? I mean, some place that I also like is like Gary, Indiana. Not a big fan of Indianapolis. Just too many people go there, right? Indianapolis for turnkeys, just like how Memphis was back in the day. Harrisburg, York, Pennsylvania is kind of a one that not a lot of people know about. But yeah, Alabama, Florida, Georgia, Mississippi, Oklahoma, everything in this area. I mean, it's all game, I think, as long as you hit the 1% rental value and make sure you're just not in a market with less than a 250,000, 500,000 population. And, that's for starters, right? But I encourage you guys to check out that free light course. And if you guys are really serious about it, go and buy the remote investor e-course. I think it's a couple $100 now. You guys can find that at the products page. All right, next question. Assuming I have $1 million at age 20 from extremely disciplined and strategic day trading, other than real estate, rentals, Forex, gold, silver, and the usual value investing, what businesses will generate 20 to 30% semi-passive income annually? So something I went down this road maybe a year ago is I started to look at like angel investing or startup investing, and every town has like these angel groups. And what I realized that people investing in this stuff, they're typically very affluent, but I quite honestly don't think that they're the best investors because sure, when one of these investments blow up, it goes up like 20, 100x. But most times if you were to average it out, the ones that blow up are like less, like 1 to 5% less. So you take the, at the end of the day, I would rather have 80% of my investments do pretty well and make me 20%, right? I mean, it's just a math equation. Which one would you rather have? In terms of, and not to offend any angel investors out there, right? The reason you do it is because money is really no object to you. You want to make an impact and you want to help out the entrepreneur, right? But like, I'm at a point where I'm actually want to invest my money for growth at this point in my life. So I like businesses that, and they would generate probably 20 to 30% at the very least, I think, would be things that are currently cash flowing. Like, I don't want to invest in anything that doesn't have a current P&L. And this is why we buy stabilized apartments that are cash flowing. Imagine that. But like, things that I'm interested in is in the website world, which is not a hard asset, right? So, you know, give me grace on this. I'm always preaching hard assets, but not in, like, there's content websites, like YouTube channels. There are SaaS businesses, e-commerce business that generate good cash flow. Those would be the types of businesses I would be in. Simplepassivecashflow.com, the videos, the YouTubes, the blog articles that we have. I'm essentially a content channel, right? I'm a content business in a way. So that's what I know. So that's what I'm going to invest in. But like I said earlier, the wealth whispers. Wealth does the most boringest things. Very common businesses are like car washes, laundry facilities, very basic necessities, like that type of stuff. I think those things are actually better these days because it's not a cash business these days, not the coins that get stolen all the time. But look for businesses that are very basic necessities. Um, Unfortunately, a lot of times, like the difficulty to run these businesses might need a little bit of a trade experience, and you have some experience, and if you already have $1 million at the age of 20, that's enough to just let it roll into real estate at that point, and maybe keep doing your day trading. That I don't think you don't need to go into a business and go through the trouble of learning it and the sweat equity that's involved in there. Maybe take a binary approach, right? With, yeah, you created your wealth thus far with what you're good at, but then you put that into real estate once it reaches a certain threshold or bucket, and you let the real estate just kind of move on cruise control. Maybe it doesn't grow at 30% plus, right? But it grows while you kind of keep doing your own thing. And this is the whole concept that I said earlier, right? Forever 21. They got to that, they built that wealth doing one thing, but the industry changed, things changed, and what they should have done is diversified into other industry specific things that they could leverage off of. And they also call this the tailwind type of way of investing, where you kind of hedge yourself internally with different investments, as opposed to going into an equally or maybe even more risky type of business and to make more returns there. Um, but that's just my thoughts. Every situation is different, depends on what your risk appetite is, and depends what your goals are. Most of the people in our family office group, I mean, the goal is to get the $4 or $5 million net worth in a semi short period of time, 5 to 10 years. And that is very doable once you've gotten yourself up to accredited status. That why would you want to be taking these bigger risks with businesses, right? Or even to more extreme example, why would you want to be taking this risk on these angel investments where it's like a 1% chance of doing well? Um, but yeah, I mean, different parts of your portfolio, of course, asset allocation, different risk areas. But businesses are another way to look at this is like you want non-correlated with the economy type assets is a big thing that a lot of high net worth people will talk about. And you do that after your net worth is maybe above 4 million. But something to start thinking about now since you have $1 million at age 20, go into things that aren't correlated with the economy. And this business that you're talking about, I think you're talking about, that is highly correlated with the economy. Hello, wandering duck. Next question. Can one invest in real estate for passive income after retirement? Sure, you can do it before retirement. You can do it today, right? It doesn't matter. It's not discriminatory against your age, like being a computer programmer, I guess. So what people tell me. Uh, but yeah, I mean, you can invest whenever you want. It's not like a pre-retirement, post-retirement things. I'm not a big fan of using retirement plans. We're not going to get into that today. We'll do another show and topic on that whole debacle that's going on lately, where they're kind of going after people's retirement funds and saying you can't invest in private placements, which I think is kind of messed up. If I suddenly came into money at age 65 and wanted to invest in real estate for retirement, what is a realistic period of time I could do it to be passively well off before I die? Well, it depends how much money you have. And in real estate, unless you're doing some crazy stuff or doing, more higher risk, high return developments, I think, hitting anywhere from 10 to 25% is a good large range to be thinking about. So you tell me, what is your goal for retirement? And I think divided by 0.15, I guess, would be the amount of money you would need to have this in investments to be able to be making that yield to hit that monthly cash flow amount. Um, People tell me, they book these onboarding calls, and people have these like, my goals are. It's like I don't care what your goals are. It depends what you have today, and what you can get from like 10 to 25% is your point of certainty or uncertainty. Right? It doesn't matter. I don't care if you want to own 100 units in the next 2 years. Sometimes it ain't gonna happen. Yeah, I want to fly too, but I can't. I don't have wings, and I weigh more than a pound, so it's not gonna happen. Um, I think people read into that mindset stuff too much, where they like make your goals. Like, yeah, that's one thing, but like have it being realistic. If you're investing in real estate, you're investing in a hard asset, and which is a good thing. But the bad thing is you're not going to grow your money asymmetrically like some other high risk investments. Which for some people that's exactly why you're in real estate. So for a lot of people, they want to be having a $10,000 a month passive real estate investing goal. So that's $120,000 a year. I think if you invested $1 million, you could probably achieve that in cash flowing real estate, no problem. Um, I think what you'll probably realize at that point is $10,000 passive income a month isn't very much. And you're probably going to need more than that. But the cool thing is that when you invest in real estate investments, especially value add, it continues to grow and it outpaces inflation by quite a bit. So you should be fine there. Um, why do rich people bother running a business or investing in real estate when they can live passively off an index fund slash stock market? So why are rich people rich? Because they focus on the goal, they work at it, they build up systems and networks and uh, intellectual muscle to figure out and solve problems. And once you've done it once, it's easier to do it again. And for some people, it becomes an ego thing which is nothing wrong with that, right? Let them do that, right? If they're solving other people's problems, let them get bigger and bigger, is what I say. I mean, if you make $5 million, $10 million, yeah, you can put it into real estate, and even at something at 5%, you can hit your cash flow goals and then some. You may not be, going from private jetting from place to place, but you're going to have a very comfortable life where you don't have to work anymore. But most people who got to that stage, there's a reason why you got to that stage because you're wired up differently. And a lot of people in our family office group are kind of the same way. The reason why they busted their butt to get the college degree, to get the career they wanted, to make multiple six figures at a day job or to cash out of their business, because they're wired a little bit differently than the average person. It's just not a matter of getting to the end of the race and never racing again. You see it as solving problems, or the way I look at my investing is like I'm just going to keep doing what I'm doing, and what I like about it's kind of a fun game of just solving problems and puzzles. Why do people play Legend of Zelda? Oh, I like the puzzles, I like the solve. I like that. I get that rush after solving and accomplishing things, setting a goal, going after it. Um, so For some people, they call it the score, right? And the score is your net worth. They just like to see that going up. Scrooge McDuck, he's a cool cartoon character, but he liked to swim around in his quarters. And sometimes I kind of like to do that same thing. I mean, that's kind of weird, but I think a lot of you guys like to do that too. But I think at Endgame, personally, like people have asked, like, okay, what do we do? Like these investing in rentals, syndications, and private placements, it is a little bit semi-active, right? You got to wake up, turn your computer on, and you got to make decisions, sign documents. If somebody, for a lot of spouses that are not really interested, they've got other interests. Is if the primary like real estate investing um, champion in their family dies, it's probably not sustainable. They probably wouldn't know who to invest in, and they probably invest with the wrong people, and that can be dangerous. So I think after a certain point, once you hit the $5 to $10 million, your portfolio starts to change from private equities, investing with direct sponsors, to more life insurance products. And this is kind of where the infinite banking comes in. If you guys want the e-course on that, simplepassivecashflow.com/banking to get that there. But you start to create these tax-free, litigation shielded, pretty much guaranteed dividends. Um, in IBC using whole life or index universal fund. People call this premium financing, but it's only available to more higher net worth people above $4 or $5 million net worth, and it's a way of kind of creating a turbocharged annuity, and that is how people kind of transition. Um, Life's fun because you can keep doing what you're doing as a business entrepreneur, as an investor, but you never know when you're going to die. And we've seen it many times. We've bought properties, and the will just sells it to us at a pretty good price because the the investing champion in their family who unfortunately passed away didn't set the spouse up or the kids up right, and they kind of left everything out there, right? The thing, the mindset of they got caught with their pants down, and you don't want to do that, right? Like, I mean, I don't know if it's appropriate to say like at age 45 you kind of change everything to a triple net lease portfolio, IUL, premium finance, infinite banking. It's not practical because chances are you'll die right before you pull the trigger on that stuff. So maybe the most appropriate thing is the different stages in the game. Every 5 to 10 years, you kind of asset allocation into that type of format. But that's what we work with in the family office group. Most of us are accredited investors. In fact, all of us are accredited investors. Most of us are definitely getting more to the in-game strategy where that type of activity is being taken place, where it's not really about investing for the best returns. It's more about capital preservation and kind of succession planning within the family. And that gets us to the end of the questions that you guys submitted. If you guys want to submit a quick question here, put it into the comment box below. Here's that disclaimer. If you guys think that this is legal tax investing advice, guys, don't do that. Don't do that. But if we have not connected yet, join the club, simplepassivecashflow.com/club, and you guys get that one free onboarding call where you guys get to ask all the questions you guys like there that are more personal at that stage. But we'll open this up for some questions here. I don't even know what this Evergrande issue in China. I don't know. I invest in the United States. I'm very simple. I mean, population in certain submarkets and how does the neighborhood look? Is the P&L showing me that it's making money every month? I invest. I mean, I think too many people, a lot of people sent me a lot of stuff recently about inflation, YouTube videos, and this and that. Guys, stop clicking on the clickbait of info marketers, guys. Always figure out how people are making money. You're just selling just day trading attention, in the words of Gary Vaynerchuk. Any other options before HB? I still like HB. I'm actually going to have George on the podcast. Well, I don't know when on the podcast, but I'm going to talk to him maybe I think in a couple weeks. We're going to record another podcast. So I don't know when that podcast is going to be releasing. But what I pour several $100,000 in my infinite banking, right? I mean, that's what that is all about. That's where you're going to make that yield as you wait for that next syndication deal. Wondering, Doc, you had $400,000 in cash. Would you start a whole life fund? Or, dude, I mean, I need some more context than that, right? Like, are you worth $10 million, or you only have $400,000? Like, big difference, right? If your net worth was $1 million, I would say, dude, what are you doing? Invest that money. You're not. You need to invest it more to get up to $5 million net worth. If your net worth was $3 million, yeah, I mean that's what infinite banking is for, right? When your net worth gets to be more than $1 million, you have these types of liquidity problems where you have $400,000 sitting in your pocket doing nothing. You basically got your thing in your hand. You're not doing anything. So exactly, you want to fund your infinite banking policy, maybe with a couple $100,000 a year for six years. You stick that money in there, and you take it right back out to invest in syndications. But I think that's the last question, and we'll see you guys next time. Bye.